In this video, I am going to explain common mistakes that first time investors make when they are trying to grow their wealth, when they are trying to grow their money. So many people have appetite of growing their money, but the problem is they normally lose this money to some little mistakes that at the end of the day they fall back into the fear that was holding them back. I have conducted series of surveys in my social media handles, and the outcomes has shown that so many people are actually interested in investing. They want their money to work for them, but the problem they are facing is they don't actually understand a lot of things. So let me show you three common mistakes that first time investors make. So number one common mistake first time investors makes is that they start chasing returns, high returns. You all know what that we said, is a risk. Investment is a risk, and the higher the return, the higher the risk. So many people pay attention to returns when they are trying to make investment. They are paying attention to how much am I getting back, what is going to be the return. So many organizations that lead people of their wealth over time normally promises instant returns. So you imagine you are in a country that the inflation is around 10 to 15 percentage, and at the end of the day the return is promising you 20 or 25% in 1 month. You should know that that should be a red flag. So when you want to make investment, stop chasing high return. And what normally happens is that when some of these first time investors heard this high return, their brain switches, their brain cool off. So every other things that you will say, they will not listen to it anymore, aside the high return that they were being promised. So the first common mistake is chasing high return. High returns can be very attractive in promise, but it can rip you off your hard earned money. So when you are being promised high return, if you ask the first question, what do you stand to lose? Not what do you stand to gain. Then the second mistakes that first time investors normally make is investing their emergency refund. People so first time investors normally invest everything they have, because the appetite and the desire to enter the investment circle is high. At the end of the day they end up investing all their money. So I call that gambling. Because why will you invest everything? So if you are investing any money that you will need to solve your immediate needs, the money that you need to solve your immediate expenses, that money is not meant for investment. In my previous videos I have also talked about this, and it is a common mistake that I believe most investors need to listen. So if you are listening to me, if you are watching this video and you are first time investors, you don't invest your emergency money. Don't invest money that you need to solve your immediate need. Those such kind of money are not meant for investment, except if you have a structure, you understand some certain things, that you can go on short-term investment that within 2 3 months your money is out. So the second mistake is they invest their emergency fund and it put them under undue pressure. Then the third one I want to talk about in this video is they don't have investment allocation strategies. The strategy in the sense that they just invest randomly, and this also happened to me when I started investing. You come or you because you have appetite to invest, you just buy things randomly. If they are in the stock market, today they go, you just buy. Today they are in stock, tomorrow they are in crypto, next tomorrow they are in real estate, in agriculture. They just start randomly. They don't have a strategy for it. If you ask them why are they buying this, why are they buying that, they cannot easily really tell you why. So let me quickly introduce you to a simple rule I call my 3R of investment. So my 3R of investment is this: it is risk, it is return, and it is reality. So what does that mean is that you go for risk first, return second, and reality always. Risk first is that first of all you have to protect your capital. You have to ask a question: this money I'm investing, what might go wrong? Then after you consider the risk, you now talk about the return. How much will I make? How much will come back to me? How much this money is going to make for me? Then always pay attention to reality, to reality, which is the third one. Don't base your thinking on assumption. Reality is to make all the necessary checks to see what can happen. So have my 3R at the back of your mind, which is risk first, return second, and the reality always. Investment is sweet, is enjoyable because you are using it to protect your future, but avoiding common mistakes will make you to enjoy this appetite of investment. Thank you for watching this our enlightenment video again. This series is on building investment appetite. We have so many of them. You can check our videos. Don't forget, anywhere you are watching from, follow, share, so that other people may benefit from it. Thank you for listening.